is always something I think that's good for us to keep an eye on, is what's driving some of the numbers we're seeing. So if you look at this, I went back to January of 2000. We could have gone back further, but I think this is pretty illustrative of some of what we're dealing with in this day and age. As you can see, January of 2000 to March of 2012, we've been up, we've been down, we've been up around the 1500 mark, we've been down in the 7s, we've been back up in the 1500 range, we've been back down in the 7s. Now we're in the 1400 range. We're all over the place. And some of the product design that we've taken advantage of, some of the fixed index products that we've all been able to utilize for our clients and even for ourselves, has really been able to take advantage of some of this volatility, in the sense that there's a ratcheting formula or a ratcheting feature where if the market's up for the given year or month or whatever window your particular product is crediting off of, if it's up, you get paid, and if it's down, you just get a zero, which has been very effective for us, especially here. If you look in late 08, early 09, that's really down. If you had naked market exposure, you took a serious haircut during that window, and then of course back in 02, and then there's been some other minor ones. You know, I guess the point being here is we've really seen historical market volatility over the last decade or so, or probably you could even say going back into the 90s or even some in the 80s. But really, for our lifetimes, this is a historically volatile stock market, and that's driving a lot of the things that we see in the products we have to offer and the best strategies we have for taking advantage of it. And then on top of that, to move along here, let's take a look at another thing that drives our favorite life and annuity products. This is a 10-year bond yield. And this goes all the way back to 1962, or I don't know if that scale's exactly right, let's say the early 60s. And you see 4%-ish rates up there, and then all the way up to the peaks where you saw really historically high returns back in the inflation of the late 70s, early 90s, or late 70s, early 80s. And then it's been kind of trending lower ever since. But if you look at the last year or so, we're pegged right around 2%. I actually checked the 10-year bonds right before we logged onto the webinar here, and I saw it finally broke through 2%. It was like 2.01. 10-year bond yield according to this formula. And as we know, most of our insurance carriers have a large amount of their reserves in bonds of this type, government issue bonds, and they're paying about 2% right now on a 10-year. So we're seeing, that's why every morning when we open up our emails, and all our favorite carriers have sent us their news of the day, we're afraid to open it because we don't want to see what the new crediting is, because it's almost invariably lower than what we had even a few weeks ago. Certainly lower than what we had a few years ago when we had fixed index annuities paying nice 10% bonuses and guaranteed 4% fixed rates and high caps and spreads and all those wonderful things that we all were able to capitalize on and help our clients take advantage of as well. But those are harder and harder to find. Really good crediting is very difficult to find these days, and usually there's some kind of a trade-off. Either you got to lock your money up longer, or you have to have fewer bells and whistles, fewer guarantees, whatever the case may be. So with that, that's kind of our theme of our webinar today, is we have linked benefit products that offer some advantages to our clients by insurance companies doing what insurance companies were originally designed for, and that is to pool risk. So as insurance companies pool risk, they can offer benefit based on aggregate tables and mortality and life expectancy tables and those kinds of things, so they can offer benefits by pooling risk. And those are not quite as sensitive to this bond chart that we're looking at, as some other products that just are offering a rate of return. So given that, I'm going to turn it over to Grayson here in a minute. But real quick first, we here at SilverSide always strive to stay on top of what's on the market. Given this low rate environment, that's almost a daily battle, because all of our favorite carriers are struggling to try to continue to offer things with some sizzle for us and with some real benefits. So at SilverSide, we're always trying to stay on top of that. So I just wanted to point out a couple, 2 or 3 products here that we have found that we consider to be our hot products of the day, that even in this low rate environment, they're still offering maybe a little bit better benefit than what we see on average. So I'm going to go through a couple of those, and then I'm going to turn it over to Grayson, and he's going to give some more details on the linked benefits concept that SilverSide really specializes in at the end of the day. But here I'm going to show you. I'm going to punch up a little sheet here. I'm hoping it came up. And yes, it looks like I had to double click on it to get it up. Here's one hot product we really like here at SilverSide. This is a 5-year MYGA, 5-year multi-rate guarantee annuity that offers a 3% guaranteed rate. A couple years ago, that might not have been too exciting, but now that's a very competitive rate. And the one thing we like about this product is it has a free 8% roll-up income rider. I don't know which of you folks out there are familiar with that or work with income riders, but one of the big problems that we see with a lot of the income rider products on the market today is there's a significant fee for the income rider, which almost boxes your client in a corner to make a commitment when they buy the annuity or when they fund it. Where are they going to be in 3 years, 5 years, 7 years down the road? Are they going to want to use the income rider or not? Because if they're paying 100 bips, 110 bips for the rider, they're going to need to use it. Well, that's why we really like this MYGA 5-year, 3% walk away. Great product if you just use it for that. There's a free rider included, so if at some point down the road you want to see, hey, what would lifetime income be? We can calculate that, and that's another option for you. We like the particular company. This company is Oxford Life. Although we're just mostly presenting concepts today, I'm going to give a couple of details on what carriers we're talking about. Oxford Life, they generate marketing materials branded to the agent. We really like that feature. It helps you put your own marketing program together. And they have a great trip. It's a carrier-sponsored trip to Disney World. Low qualification, only $735,000. Ask your marketer about that. We're going to end up having a lot of folks on that trip. And also, the Oxford has another. They have a 10-year chassis income rider product. We like that as well. If you're interested in something that maybe has a little bit more substantial commitment on the part of your client, and thus a little bit more substantial benefit, pays a little bit higher commission, a little bit longer chassis if you have a client that might be interested in that. The 10-year bonus product is very competitive. So let's move along here. I don't want to take up too much of Grayson's time. We're working with Sagicor. They're rolling out their new non-med whole life and universal life system. Non-med, we're not talking about guaranteed issue here. We're talking about underwriting competitive rates with no blood draws, no fluids, no APSs. They're writing it in a 10-minute phone interview, so they can get these things issued 24 to 48 hours. Electronic application, you can be paid in a couple of days on these, and these are competitive universal life and whole life products. So most of us work largely with annuity products and with more investment style life products, but these, you may need these available for quick turnaround on competitive rates for your clients. Ask your marketer about that. These are from Sagicor. And there's one other product I'm going to touch on here, and this is Sagicor's 9-year annuity, and it's almost like they forgot about it because it still has a 4.5 S&P annual point to point. That's unheard of in this market. The 2% fixed account, that was not a great fixed rate a couple years ago. It's the best you're going to find nowadays. And also a really hot feature of this product, this is the most liquid indexed annuity out there on the market. It has a cumulative roll-up. on your free withdrawals. 10% per year, but if you don't want to take a 10% year one, you can take 20 in year two or 30 in year three, accumulates all the way up to 50%. So this is the most liquid indexed annuity on the market. Great crediting. Like I say, we don't know if Sagicor forgot about it or if they just have some old bonds that are still crediting well enough that they can afford to keep this thing out on the market. So with that, I know I hit you pretty quick with a rundown there. Go ahead and give us a call, and we can clear up anything that we just touched on that. So I promised you I'd get you Grayson, and he's going to go into some details for us on some concepts of linked benefit life and annuity. Grayson, are you available, or have I put you to sleep yet?
I'm ready to go. Let's do this.
Okay. Without further ado, Grayson, please tell us what you can about some of the better linked benefit life and annuity concepts on the market today.
Okay, guys. Hey, thanks a lot. You know, obviously Rick showed you it's a pretty tough environment out there for retirement planners because, you know, it's tough to get much bang for the buck, so to speak. So we're going to talk about, you know, that being one of the problems. I'm going to show you another problem we see out there, and then I'm going to show you a solution to these problems. So let me post my screen up here. And, you know, like Rick said, we're throwing a lot of information at you today, and we know that, so go ahead and write our number down, 480-998-1286. Talk to one of the marketers here, and we're going to talk about some stuff. Hey, if you are a retirement planner, you need to show the products I'm about to show you, or at least the concept that I'm about to show you, or somebody else is going to, okay? Because in this low interest rate environment, there's another issue, and that's America's getting older. We've got 70+% of seniors are going to need some sort of long-term care. Now, that's not necessarily nursing home, but they're going to need some help. Funny part about it, though, guys, 90+% of retirees, people 65 plus, have no private long-term care insurance or Medicare. Excuse me, Medicare is going to cover very little of long-term care expense. Now, let me tell you, let me rewind for just a second. If you do have some questions, go ahead and type those in, and then we'll try to address those at the end of the webinar, so we don't, so this thing doesn't take too much longer. I'm gonna talk about 25 minutes here. Now, long-term care costs are growing around 5% per year, so this is absolutely kind of the perfect storm coming to your retirees, your seniors' finances, and their families' finances. So, hey, I added that again, we kind of spiraled that in so you can understand. This is a huge issue. And some people are calling it the next financial crisis that America's standing up to. Well, I do workshops around the country about asset-based care, about coverage for long-term care, and so I'll stand in front of a group of retirees and seniors and say, why don't you have coverage? Universally, every single time, the number one response I get is it's too expensive. $3,000, $4,000, $5,000 a year. And they feel like, the average retiree feels like these are premiums they're paying just like car insurance, just like home insurance. Hey, if their house doesn't burn down, if they're not in long-term care, all the money's gone. That's how they look at it. And on top of that, what is actually covered by these policies can be really confusing to seniors, you know, with all the fine print. And, you know, they just don't, it's such a tough topic to talk about. They don't want to, everybody knows someone who's been in a retirement home, you know, I mean, a full assisted living, and that's what your clients think of when they think of long-term care insurance. They think of being in confinement. Well, they don't want that. And then what happens after that? Well, then they're gone. So it's a tough topic. And the underwriting can be intimidating as well. I just posted that. Sometimes I will get that response where they don't feel like they're in pristine health, but they surely don't feel like they're in bad health. They think the insurance companies are completely cherry-picking the healthiest, and those are the only ones that can get any coverage. So at the end of the day, well, I put this little caricature together because it depicts the situation America's rolling into. We have a senior, And the pink elephant in the room is, hey, all these healthcare costs, it's going to chew up savings, chew up the grandkids' college fund, everything they're going to inherit. Medicare is going to be reducing benefits. So this is just a little eye catcher, and try to at least have a little bit of a laugh with it, because, like I said, it's a difficult subject to bring up with your clients, but it's something that has to be talked about. So what are we going to do about it as retirement planners? Well, the best approach that I've found is to reference tax laws that are changing to help seniors protect themselves for long-term care, to cover themselves. Part of the Pension Protection Act of 2006, but just took effect at the beginning of 2010, seniors can take withdrawals from specially designated annuities, income tax-free for long-term care. Now, 1035ing old annuities into these HIPAA-compliant long-term care annuities is a powerful concept. A lot of your retirees have some older annuities. They're afraid to take money out because they know that tax deferral is kind of becoming a tax time bomb. If they take money out, there are going to be a lot of taxes. Then they have to pay more taxes on their Social Security, and it rolls downhill on them. Well, if you have clients that have older annuities, and by older I mean they're down to 3, maybe 4% surrender charge with some tax-deferred gains, and they have no coverage for long-term care, you have to show them this product. This is a basic concept. I'm going to show you the best of the annuity products that provide these benefits. But get us your specific client situation, and we can get more detailed than I'm going to right here. So the basics of these annuity products, this particular one's coming out of an A-plus carrier. This is a single premium deferred fixed annuity. It does have a built-in continuation of benefits for long-term care, kind of like an income rider, if you're familiar with those products that are out in the annuity world. Now, withdrawals are non-taxable when triggered for long-term care related expenses. So you've really got two pools of money. You've got your accruing annuity that you can 1035 in. If your client never needs any long-term care assistance, that money is still there for their estate. It's not a if you don't use it, you don't lose it situation. But if they do have long-term care, then there's a leveraged up amount, kind of like an income rider, that they can use for long-term care. It can be single or joint, which is a strong concept as well. You can add, if you have a married couple and there's an older annuity with tax-deferred gains just in one of their names, you can still 1035 in and add this spouse as an eligible person without a taxable event. And I know I'm going through this stuff pretty fast, guys, but if you have questions, go ahead and type them in. Conservative surrender schedule. Not going to focus too much on the numbers, guys, but I want to show it to you so it takes a little bit better shape in your mind. Let's say after a year, let's say you have a 65-year-old lady. She's a client of yours. She's got an older annuity. She's not going to use for day-to-day, month-to-month expenses, but she's got no long-term care coverage. So you 1035 that in to this HIPAA-compliant annuity. There's some accrual after a year, but here's the big thing. Here's where the bang for the buck comes in. And in this low interest rate environment like Rick showed you, this is a powerful tool, guys. $455,000 of the insurance carrier's money is included for a total long-term care value of $556,000. This lady has an 11-year monthly benefit of $4,200. That's where there's a huge bang for the buck. It's all income tax free. And after 10 years, like I said, I don't want to focus on the numbers, but you see them here. There is some growth. There is some accrual after 10 years. So, hey, at the end of this, if she's still, now she's 75, now she has $616,000 tax free to use for long-term care. That could cover any Alzheimer's horror show, 11 years worth of payouts. So I show you $600,000. How does your client access that? Well, that total benefit value can pay out up to 11 years, 138 months. It can be priced as an indemnity, meaning your client just gets that same amount every month. Even if they're only spending $1,000 on long-term care, they still get that full monthly benefit tax-free, which is that's a powerful tool in and of itself, a tax-free income stream. And the trigger, so how do they access that money? Licensed care provider or physician signing off that they need help with 2 out of 6 activities of daily living, or they're cognitively impaired. So they don't have to be in a nursing home. Make sure that when you're sitting down with retired clients, they understand that they don't have to be confined to access these benefits. No waiting period, 90-day elimination period, which means you get this policy issued for your client, they get in a car wreck the next day, and they can immediately trigger the benefit. The first check will come in 90 days, but they can trigger immediately. So if you are, obviously we're referencing an annuity here, so if you traditionally sell annuities and you don't have a lot of experience with underwriting, do not let that intimidate you with this product. It's simplified, much more concise than traditional long-term care. 12 questions about your client's medical history on the application. We're not talking about blood draws, exam records. The MIB, which is the Medical Information Bureau, with a point of sale telephone call, the underwriter is going to bring up the MIB, history and electronic database of your client's medical history, whatever they've been diagnosed with, whatever pharmaceuticals they've been prescribed, will be on the MIB. Now, just for a point of reference, on the underwriting side, guys, as long as your client hasn't had serious heart issues in the last 5 years or internal cancer in the last 5 years, and whatever condition they have is controlled, they're more than likely going to qualify for this product. Now, even if we actually have some long-term care coverage that doesn't require any underwriting, but for this annuity and the life insurance product I'm about to show you, it's about a table 4, if that makes sense. Now, again, I'm showing you kind of from 10,000 feet, a high level. So what we're going to do at the end of the webinar is you guys call in, we'll give you our asset-based care worksheet, basically just a one-pager of questions to ask new clients, to ask clients when you're doing an annual review. You get that back to us, and we will show you what the best products for your client's specific situation financially and health-wise, what the best products are available to them. Even, like I say, even clients that are in very bad physical shape, we have some solutions that don't require any underwriting. What I just showed you is about a table 4, if that makes sense. So, hey, look, this particular strategy, now your seniors can increase their rainy day money, the money they're not, maybe sitting in an old annuity, they're not intending on using it for month-to-month expenses. They can increase that money 550%. You're leveraging up tax-deferred and making it tax-free. Guys, write that one down. Tax-deferred to tax-free is a good catchphrase when you're talking to clients that aren't familiar with this type of thing, okay? Turning tax-deferred into tax-free. Hey, Hancock did a survey of all of their clients that actually did get long-term care insurance, and they asked them why. What was the driving force to get you to pay for long-term care insurance? The number one response was independence. And if you get your client that tax-free income stream, it's just for the fact that they need some help. They don't have to be in confinement. That is going to help them maintain their independence, help them stay at home longer, make sure they don't outlive their money and spend all their money on care. So again, it's a couple more catchphrases because I know the concept is so strong and so applicable to so many of your clients. But where's the bridge? How do we present this kind of thing to our clients? How do we get there? Well, some of the catchphrases that are going to help you, and this is our experience in years of marketing these products, guys. Tell your clients, hey, we're not talking about continual premiums that you have to continually write checks out of your Social Security or your pension. One-time investment, if you don't use it, you don't lose it. It's still there for the heirs. 1035ing from old annuities is so powerful. You're leveraging up tax-deferred and making it tax-free. And you can do partial 1035. So if they have larger annuities that they think it would be overkill with all that leverage, that's fine. Adding an eligible person, this is key. You're not going to run into it very often, but so many times, like I say, the older annuities, sometimes that's the last thing your clients want to access because they know there's such a taxable event when they take money out. Well, now you can 1035 that in, add the spouse as an eligible person. They both have coverage. And if they can't qualify for standalone long-term care, this is a simpler qualification. So that's a good way to look at this, guys. If you don't show this to your clients, somebody else is going to. So keep that in mind. I wanted to go into one of the life products because, of course, and really where your client's money, where their asset is that they would potentially use for long-term care, where it's sitting is important on, hey, what's the most effective strategy, life insurance, annuity, whatever the case may be. But before I go into that, Rick, do we need to cover any questions?
Well, I don't know. One other catchphrase we like to use is you ask your client if they are self-insuring for their care in their older years. Okay, you're self-insuring. What asset have you earmarked for your care-related expenses as you age? And if they say, oh, it's we have the savings account, oh, we have the CD, oh, we have this account, we have that account. Great, there's the opportunity. Let's take a look at what vehicle they have it in now. Once they identify, okay, that's what we're going to use, okay, what can we do to maximize the leverage, given that that's what we have to work with? And that's really what this whole asset-based care concept and the case design we're working on here is all about.
Yeah, that's a really good point, Rick. You know, when these products first started developing 4, 5, 6 years ago, and Rick and I started putting it in front of agents, I would continually hear the agents say, well, my client's self-insuring, so they don't need these products. No. That's 180 degrees off. If they're self-insuring, that's what these products are for. So if you already have yourself covered, well, why would you not do it tax advantaged? Why wouldn't you do it leveraged with some of the insurance company's money? So your self-insurers are exactly who you're looking for these products. Now, like I said, for the annuity, tax deferred to tax-free is powerful. 1035ing old annuities in is a no-brainer. Now, let's take a 65-year-old lady that's your client, and let's say she has a CD, $100,000 CD coming due. She's been paying taxes the whole time, you know, getting 1099, and she's tired of getting 0.7% or whatever the annual rate is now. So let's show her a life product, and I'm going to put the numbers on it so it takes shape in your mind. But again, many different life products and strategies. So the concept is the most important thing to grasp. But this situation, one of the products we use, she gets an instant 10% bonus from day one. So $110,000 net premium day one to buy life insurance. This really, take a look, guys. It almost doubles her money, tax-free overnight. And in the low interest rate environment Rick showed you, how long is it going to take for your client to nearly double their money tax-free on an after-tax basis? It's going to take decades. We can do it overnight. Now look, there's some indexing. So this is indexed for the upside but no downside risk with stock indices. So you see there, if the future equals the past, there's some good growth on this thing. No extra licensing is required, guys. You don't need a Series 7. Series 6, anything like that. So great. You say, well, Grayson, so I almost doubled my client's money overnight, but it's in life insurance. What good does that do her? Well, that's this next line: $6,000 chronic illness benefit paid out monthly for 33 months. That's how it helps her. It's truly and acceleration of the death benefit back to her. Now let me rewind just for a second, because I should have mentioned this straight out of the gate. A life insurance. Now, when I'm doing workshops trying to explain asset-based care to groups of retirees, a lot of times I tell you what, I use the term life insurance and people will roll their eyes at me and they'll say, Grayson, you know, hey, my kids are long out of school, you know, the house is paid for. What do I need life insurance for? I don't want to keep paying premiums, and I don't need any life insurance. Well, here's a catchphrase that I want you to write down. And any of your clients that you can approach with this is a powerful tool. Say, hey, listen, I want you to understand before we talk about this, Mr. and Mrs. Client, life insurance is changing. Now we have life insurance, still tax-free, but you don't have to die to use it. Powerful strategy. And at the end of the day, in our particular illustration here, well, you've almost doubled your client's money overnight, and if they don't use it, they don't lose it. Their kids get a larger tax-free inheritance. So as long as you start off a conversation from the right perspective, hey, life insurance is changing, so bear with me till I show you what's going on here. Really, life insurance just turns into, it really becomes the vehicle that we're using for this investment. Similar trigger to get access to that death benefit. Your client has a licensed physician sign off that they need help with 2 out of the 6 activities of daily living, and a portion of that death benefit is going to be accelerated back without a 1099 to your client for 33 months. This is an indemnity, not a reimbursement. They don't have to justify expenses if their doctor said they need help. That help, they could pay their granddaughter to come over and cook and clean for them. There is a 1-year waiting period on this, and the maximum accelerated back to the policyholder for chronic illness is $250,000. Now, hey, you can instantly increase your client's estate and simultaneously decrease the estate's taxability. Heirs are positioned for a larger tax-free inheritance, and again, they keep control of their money. So the concept of wealth transfer to the next generation with life insurance, that's not a new concept. What is a new concept is how easily your client can access the death benefit of the life insurance for themselves, so they don't lose control of this. So if you have some clients that have these CDs that they're not going to use, they have no long-term care coverage, but they are concerned about what they leave the next generation, this thing is a no-brainer. Okay, now let me continue a little bit here, because I want to show, you know, when we're talking about where's the money coming from that your client's going to self-insure with, so many times the money that they have that they don't need for monthly expenses is in a 401k IRA, something, you know, qualified money. I want you to know we still have strategies for that, and I'm going to show you one real quickly here, and then we're gonna wrap this thing up. But let's say that same 65-year-old female client of yours, instead of an old annuity or a CD, she has a $100,000 IRA that she really doesn't use. She isn't using for month-to-month expenses. What we're going to do is we're going to transfer that IRA into an immediate annuity that's still a qualified immediate annuity. It's still a pre-tax annuity, and it's going to pay out 7 times, a 7-pay certain immediate annuity. So that's going to be $16,000 a year that your client is going to receive. They will get 1099 for this, okay? So this isn't tax evasion. It's excessive tax avoidance is what it is. But that is going to pay into a 7 premium version of the exact same product we just looked at. Okay, so the system is automated by the insurance carrier, so the money goes from an IRA to a pre-tax immediate annuity, pays out 7 times, but it's going to be automated to go into this life contract. Instant $176,000 death benefit. The same, like we were talking about on the single premium version, same access to the death benefit. Doctor signs off they need help, tax-free checks are coming. Same indexing possibilities, so growth without risk. and just the numbers there if the future equals the past, guys. So, hey, when we're talking about qualified money, and so many seniors have a qualified account, IRA, that they really don't need, well, as a Roth rollover alternative, hey, now we're spreading tax liability out on this IRA over 7 years. You're getting that you're not losing control of this money. Your client still has chronic illness access to that death benefit. It's on a whole life chassis, so there's no downside risk. This thing only grows as time goes on. And hey, because there are 7 premiums, it's not a modified endowment contract. So there are some further tax advantages to take out the cash value of this thing without taxation. So really, and I want you guys to sit with this concept for a second, because your seniors, your retirees that have an IRA, they don't really look at that as all their money, in my experience anyway. Let's say they have a $100,000 IRA. Well, they're looking at that as maybe $65,000, $70,000 is really their money. Well, with this concept, we are turning a pool of pre-tax money, say $100,000, into a larger pool of after-tax money. It's a powerful strategy. Think about that. A pool of pre-tax money instead of a smaller pool of after-tax money like a Roth rollover would be. You've got a larger pool of after-tax money. Well, using IRAs and filtering into life insurance for wealth transfer, again, this is not a new concept. What is new is the easy access to that tax-free death benefit for health issues. It's a liberal access to that death benefit. So you're turning qualified money into tax-free care benefits and wealth transfer. You have clients that the only reason they would use that IRA anyway is if they needed help, something crazy happened to them health-wise. And again, guys, all the way back to the first stat I showed you, 70% of seniors, almost 3 out of 4, are going to end up in a situation that they could trigger this benefit. So isn't that kind of a no-brainer? Powerful strategy. What I'd like you guys to do now, because I know we ran over a little bit and there's a ton of information here, but give us a call. Get that one pager. Now it's actually 2 pages. We've stacked on the front of the questionnaire some of those catchphrases that I was talking about. You know, if you don't use it, you don't lose it. You know, turn tax deferred into tax free. That kind of stuff. Use that to approach your clients. Get that second page filled out. It's just a questionnaire on where their money is that they would use for long-term care and some questions about their physical condition. Get that filled out. Get that faxed back to us, and we will show you what's available. This asset-based care world, Rick showed you what a low interest rate, tough investment environment we're in. Well, you saw just some of those numbers. There's some real bang for your client's buck that you can get out of these asset-based care products. There are tax advantages. So in a lot of your client situation, it's a no-brainer. Somebody's going to show them these products. So let's make it you. Give us a call and we'll get you that asset-based questionnaire right now. You see the number there, 480-998-1286. Rick, what questions or what else do we need to cover here?
Hey, that was really great information there, Grayson. And yeah, with the asset-based care questionnaire, let us help you keep track of what's on the market and what might be a good fit for the situation. We have a number of questions here about state availability, and rather than try to cover everything on every product at once, we have strategies available in virtually every state. Obviously, New York and some of the Northeast, we're really challenged on what we can offer, if anything. But on the whole, the annuity product you showed, if we use 1 or 2 different carriers to try that, we got pretty wide availability on that.
Pretty much everywhere.
Yeah, pretty much. On the life concepts, our favorite 1 or 2 life carriers are probably available, you know, about
all the New York.
A couple of soft spots. Yeah, we can come up with concepts for you. And then some of the fallback things we have for if your client really isn't very insurable, if their health is really probably not going to allow them to qualify for any real core asset-based care product, let us know. We will probably be able to come up with a strategy for you as long as you're not New York or maybe 1 or 2 other spots. So And then I had a couple of questions along the lines of, okay, Grayson's talking about HIPAA compliant, and he's talking about PPA. I'm not even really sure what PPA exactly means or stands for. And these are not super complicated concepts, even though they sometimes sound that way when we get all the acronyms thrown in. And as far as you as an agent, basically you need your basic life license. And as we all know, with all the new NAIC regulations coming down, we got to take a little bit of index training course or an annuity training course. And on some of these, you will need a long-term care training course, but that's a one-day thing or even a couple-hour thing. So really, as far as compliance and what kind of training and licenses you need, the hurdles are very low, and we can walk you through whatever that might be. So don't anybody get too intimidated when they hear about the Pension Protection Act and HIPAA and all these kind of things. That can usually mean 6 months or a year worth of coursework. That's not what we're talking about. To be able to effectively sell the products we're talking about and implement the strategies we're talking about. And then we had a couple of things along the lines of annuity versus life. And rather than try to address each one of those questions individually, what we might want to say is that with the products Grayson showed you today, generally speaking, if your client is most interested in maximizing how many dollars for care or illness they can get versus how much they have to work with, generally speaking, the annuity solution is going to maximize the dollar bang a little bit better. And generally speaking, the life solution is going to give some good leverage for illness or care, while at the same time leaving a nice pool of after-tax money available for wealth transfer if it never does need to be accessed for care or illness. So that's a generality there, but normally if your client tells you the most important thing for them is to just maximize how much care that they can get, we'd probably be looking at the annuity solution. And that can be either with qualified or non-qualified money. We can work a solution that direction. And same thing on the life end. If they say this money's for the kids or the grandkids, but really we're not ready to let go of it yet. If we really get sick and we run into trouble here, we need to have it. That might be a life solution for you. And then I have some questions here about presentation materials and slides. Yes, we do have things like that available. Get with your marketer. We'll get you what we can. If we're using specific products, we're going to have to use with company approved, with carrier approved marketing materials. So that limits us a little bit over the broad strokes that we're able to paint in a presentation like this, where we're not really getting into a lot of carrier specifics, but more in product and more in concepts. So I think we're going to wrap that up for the questions right now. I apologize if we didn't get to anything you needed real specific information on. We'll get a printout on our webinar today, and we'll make sure either your marketer or somebody over here gets a hold of you to follow up with anything really specific you need to know about. So with that, I think I'll thank Grayson. Great presentation as always, Grayson. We really appreciate it. And thank everybody for spending part of their day with us here. Give us a call, 480-998-1286.